Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Tuesday, January 4th, 2022, and I'm pre-recording this Trading Places Live for a bit later this morning. Futures currently are, they're up a little bit. We've got the Dow Jones futures up roughly about 0.25%. Same goes for the S&P 500. NASDAQ about half of that. So we're seeing a little bit more strength toward the Dow and the S&P this morning. Crude oil futures, or crude oil prices, I should say, right now, up about, well, they're up a fraction, maybe about 10 cents. They finished back over $76 a barrel yesterday. That led energy to some outperformance. We'll talk about that in a minute. The 10-year Treasury yield, which surged yesterday up about 12 basis points, up another 3 basis points today. So we're now up to about 1.66%, not too far away from the high of 2021, which was 1.75%. So we'll want to keep an eye on that. We got a couple big economic reports out. Tomorrow we get the ADP employment report, and then on Friday, of course, non-farm payrolls. That has the ability of moving both the stock and bond market. So we'll want to keep a very close eye on that. Let's go ahead and move over to earnings beats here in just a minute. I do want to just give you the agenda real quick for today before we do that. Today, we're going to go into talking technically, of course, after we start the daily market recap. Then we'll jump into the 2021 review, just a very quick review of the sectors and industry groups, how they performed on a relative basis in 2021. Jump into the earnings spotlight and wrap up the show with the 3 you must see. By the way, this is our first show of 2022 here at StockCharts.com. So I do want to wish everyone a happy new year. I hope everyone was safe over the holidays. Appreciate you coming back, tuning into the show. We do definitely enjoy your support here at Earnings Beats, and hopefully you'll stick with us throughout 2022. I think it's going to be a very volatile year. I'm going to talk a lot more about what I see in 2022 this Saturday. We have our annual Market Vision 2022 event. You can see it. It's on our homepage. All you have to do is go over to earningsbeats.com, and then you can scroll down. You can check this out. We have a little bit more information on it. It'll begin at 8:45 a.m. on Saturday morning. This is an Earnings Beats members only event, but you can be a trial subscriber. So if you go to our homepage right here, you can start a no-cost 30-day trial. That's all it takes to be a part of this event. I can tell you that last year, I think it was the first Saturday, maybe the 5th or 6th or whatever of January. My prediction for the end of the year on the S&P 500. Well, first of all, the S&P closed 2020 at 3756. 3756. A week later, when we had our event, my projection on the S&P 500 was 4750. I saw the S&P going up 1,000 points last year. A lot of folks with the COVID-19 variant thought we were going to go back down, that the rally wasn't going to last. I saw it quite the opposite. I thought we were going to have a huge rally last year, and we did. We finished at 4766, only 16 points away from that 1,000-point advance that I saw. So I was pretty pleased with the overall. As I said at the beginning of last year, though, the difficult part for 2021 was going to be rotation, trying to get the rotation correct. And that was not easy. So if you were in the S&P 500, trading the spider, or you just own the spider, the Dow, that sort of thing, you did great. But if you were trying to time the market, because certain areas were doing well and other areas were not throughout different parts of the year, it was really hard from a timing and rotational standpoint to do well as a trader in the market. I found 2021 to be very difficult personally. I think that will change in 2022, but it'll probably be in the second half of 2022 would be my guess. Anyhow, this Saturday, January 8th, 8:45 a.m. Eastern Standard Time. I'm going to be joined by some great friends of mine at StockCharts, Grayson Rose, David Keller, Bill Shelby. We're each going to be presenting for about an hour. I'll actually do a joint presentation with Bill Shelby He's the lead software engineer at StockCharts, created the scan engine. And so we're going to spend an hour just talking about scans and how you can use that to improve your stock market performance in 2022. So that will be a great session, followed by Grayson and Dave talking about what they see in the market right now, little tips and tricks to help you improve your trading. And then I'll wrap up with a number of predictions about 2022. All in all, we'll probably go until probably about 1 o'clock. So it'll probably be about maybe a 4-hour event. It will be recorded, so you'll get copies of the recording. You don't have to physically be there live. It'll be a great, I believe it'll be a great event. So make sure you check that out. Again, it's for Earnings Beats members only. So if you are interested in attending, you'll want to go in and go to earningsbeats.com. Make sure you sign up for that no-cost trial. If you scroll down a little bit further, make sure if you're not already an Earnings Beats Digest subscriber, all it takes is a name and email address. It's completely free, no credit card required, and we'd love to have you. It's a 3 times a week publication. Usually it's just 2 paragraphs and a chart. So it's a very easy, quick read. Again, 3 times a week. It's many times trading opportunity if you so desire. Of course, that's completely up to you. But it focuses on the things that we think are important at Earnings Beats. So make sure you check that out and sign up if you haven't already. All right, let's move on to what we saw on Tuesday to open up 2022. Overall, I thought it was a pretty good start to the year, about as good as I expected it would be. You know, I'm a little nervous about the market right now, so it was good to see us start off on a good foot, but there were still some warning signs. Not every area participated, so we do have to remain on guard a little bit, but there were some good things happening on Tuesday. The Dow Jones Industrial Average, first of all, up 246 points, so up 2/3 of 1%. The S&P 500 up 30, another 2/3 of 1% roughly. And the NASDAQ tacked on 188 points, which was more than 1%, 1.2% to be exact. Mid caps, small caps, you can see that there was a little bit all over the place. Mid caps gained 0.3 of 1%. Small caps actually gained more than 1%, but all five indexes higher on the session. So that was very good news. Leadership was a different story, though. I mean, this was kind of all over the place. We had energy up 3%, discretionary stocks up almost 3%, financials up 1.25%. Those were your 3 winners. But we had materials down 1.3%, healthcare down 1%, and overall the defensive groups, which led us throughout much of December, took a backseat to start this year. Now that might be a very good thing. It's early, way too early to tell, but we want the aggressive areas to begin to lead again. That was one of the warning signs that I wrote about, spoke about in December and really latter part of November. We saw this shift, and as the S&P 500 went up here to make new highs to close out 2021, it did so mostly on the back of many of the defensive areas. I mean, if you look at healthcare, for instance, look at the rise in healthcare during the month of December. So we were just seeing leadership from the wrong areas, and that can be a warning sign. Doesn't have to be. We can see that rotation shift back. And it doesn't bother me when I see the defensive groups lead for a day or two, but when they're leading for 4, 5, 6 weeks and the S&P is setting a new high, that can be a sign of Wall Street repositioning into defensive areas before a move back to the downside. So that's just one little thing that we got to keep in mind as we go into January 2022. All right, 10-year Treasury yield. Here was the big day yesterday. You can see up roughly 12 basis points, closing at 1.63%. As I mentioned earlier, this morning early, we're up to 1.66%. So we're seeing a little bit of movement. The high in October and November, we had a double top right around 170, but ultimately the double top from March was 175. So that's where bond traders have their sights. If we see continued selling in the bond market, don't be surprised if the yield were to make its way back up to test that 175 level. A breakout above it, I think, would be very noteworthy because the Fed's telling us that we could see 3 rate increases. So if the bond market starts selling off in anticipation of that, in my opinion, that would be further confirmation that the bond market now is beginning to believe the Fed will raise. So these are all things to keep in mind. If we don't get that breakout, however, in the 10-year Treasury yield, then I think that's a signal that the bond market is saying, wait a minute, put the brakes on those rate increases. We're probably not going to see 3 rate increases. So let's keep an eye on the bond market and that 10-year Treasury yield. Let's see whether or not we get that breakout. If we do continue to move higher, one thing I would look for is the downtrend, the relative downtrend in financials and in industrials to turn and start to move back to the upside. So far, we're not seeing financials and industrials doing very well, at least not over the course of the last 10 weeks or so. And that's unusual when the 10-year Treasury yield during the same period is relatively flat. So anyway, something to keep an eye on. All right, let's move on to talking technically. So I wanted to go through quickly. First, here's the S&P 500. When I look at the daily chart, I really don't see that many issues on this chart. Now, remember, we're right on the top of the surface here. This doesn't tell us anything about what's going on under the surface. It just takes a cumulative look at all the sectors, all the industry groups, and this is where we stand. We closed at 47.96.56 yesterday. And if you go back to the prior high close, December 27th was 47.91. Then we had 47.86, 47.93, 47.78. And then, of course, the end of the year, we came down to 47.66. Yesterday's close, 47.96 and change, an all-time high to open up 2022. So on the surface, good news. The PPO, which had been close to the center line, kind of got a reset here on this pullback, now is starting to move higher again. So we got momentum building to the upside. So when I look at the daily chart on the S&P 500, if I didn't look at anything else, I would say bullish, full speed ahead, let's go. But there are issues. As I mentioned, the rotation into defensive areas recently is one issue that we've got to keep a close eye on. Another issue, here's the weekly chart. I mean, we topped on the weekly PPO back in May. And as we've continued moving higher, this PPO has continued to move lower and lower. So while the daily momentum looks fine, the weekly momentum looks like we could really use a pullback. And normally, when you get these negative divergences, you can see trips back to test the 50-week moving average. Right now, that's down at 43.22, which is pretty close to the low we saw back in September. I'm not saying we're going back down there. I'm just saying be aware that there is a signal here that suggests that could be in the cards. Now, we've had negative, look at the negative divergence we had throughout the summer and into the fall, right here. PPO did not go any higher, even though prices kept going higher. Do you see any 50-day or 50-week tests? I do not. No guarantees. This market never gives guarantees, but it does tell us the odds are greater. There's more significant risk in the market right now because we still have this negative divergence. So I personally would like to see the market sell off for a period of time and get this PPO back down to the zero line, maybe even in negative territory for a bit. You know, the Q4 trade war back in 2018, you can see we got some selling here. The PPO went down below the zero line, then we resumed the uptrend. I could see something similar coming up over the next several weeks, but again, no guarantees. This is again just one more signal, bearish signal that we have to be aware of. All right. One issue or one thing I'm looking at are the transports. Now, the transports helped us back in October and November when we broke out above the May high. Anytime we get a breakout of the Dow Jones moving higher and we also get the transports, that's the Dow theory. That normally is a very good sign. And if you just think about it from a common sense perspective, when transports are doing well, think about what makes transports go up. Shipment of goods. The more goods you ship, the better these transportation companies are going to do, and the higher the index will go. Transports don't go up for any other reason besides an economy that's strengthening. And either you're shipping more goods or you're expected to ship more goods. That's the way I always look at transports. So following the transportation index is one of my favorite ways of determining whether or not the economy is strengthening or expected to strengthen. So here you can see the S&P 500 has broken out in December. Transports haven't yet moved back up to make that breakout. And you can see that down here at the bottom on a relative basis. So you see how transports did not perform well throughout the summer, but then finally we started to see relative strength. We started to see a breakout, or we saw a breakout. And that, I thought, painted a much more bullish picture, but we've kind of gone back to where we were over the summer with, moving slightly lower, relative strength, moving down. Right now, we're at about a 2.5-month relative low on transports versus the S&P 500. And that's something that we need to kind of keep an eye on. Now, I pulled up yesterday's performance of all the industry groups within the industrial sector. Airlines actually were the leader, up 3.3%. But if you look at the railroad and trucking, railroads were down 1.6% yesterday. Trucking was down 2.15%. And I bring this up because if you look at the, what's going on with the yields, we had the big day yesterday, higher in the yield. And what this chart shows us is not only the yield. So here we're moving up on the yield to 1.63%, but down here at the bottom, what I have is correlation showing the direction of the 10-year Treasury yield and the direction of the relative strength of truckers versus the S&P 500. And what this says, I've got the blue shaded area and the red shaded area. We definitely go up and touch the blue shaded area, which is strong positive correlation, much more often than we go down and touch the red shaded area, which is weak or inverse correlation. So this chart, and the same thing, by the way, down here for the railroads versus the S&P 500. So what this is telling us is that when the yield's going up, the tendency is for truckers and railroads to outperform. But when we go back to this chart again, showing the performance yesterday, the 10-year Treasury yield had a huge day, one of the biggest days we've seen in the last year, probably in the top 3. Railroads and truckers both were down significantly. I just thought that was odd. I just wanted to point it out. Normally, why does the 10-year Treasury yield go up? Normally, the 10-year Treasury yield goes up. Well, it always goes up because there is selling in treasuries. There's always an inverse relationship, 100% inverse relationship between the direction of Treasury prices and the direction of the Treasury yields. So when the yields are going up and having huge days, that means there's a lot of selling going on in treasuries. Why would that be? Why would you get out of treasuries? Well, normally you're going to get out of treasuries when the economy strengthens because you would rather be in the stock market. You're going to earn a lot more money with S&P 500 companies that are growing profits and the S&P 500 rising than you will in the bond market, because as the S&P 500 grows and as the economy heats up, the Fed then has to begin thinking about raising rates, and raising rates is going to lower bond prices. So you want to be out of bonds and you want to be in stocks when the yields start to rise and when you think the economy is strengthening. So anyway, I'm just pointing it out. I'm not making any kind of a prediction based on that. I just found it interesting that with the huge move up in treasury yields, there was also a huge move down in both railroads and truckers. That is not normally the case. I mean, we do go in negative. We do have inverse correlation sometimes. This is not like a slam dunk, but normally with a big move up in the yields, we would expect better action in truckers and railroads. The airline chart, wanted to point out, has been downtrending for a while. Believe it or not, we had a double bottom, which was a 52-week low in December. So all is not well yet with the airlines, but we did see a nice start yesterday to the new year. So I wanted to point that out. And if we take a look at railroads and truckers real quick, just to see what's going on there, they've been performing much better than the airline group. And you can see we just recently set a 52-week high. So pull back. Maybe it's just profit taking. That's why I'm not going to read too much into it. We saw some relative strength in railroads versus the S&P. Got this double top. If we really wanted to see the railroads get going, we want to see this double top taken out and continued movement to the upside. Lastly, let's look at the truckers. You can see truckers also setting a new 52-week high and also setting new 52-week relative highs. So the trucking group, I think, still looks pretty strong, even though we saw the pullback on Tuesday to open up 2022. So if railroads and truckers, these two groups have actually been strong. That's why yesterday's weakness, is a little bit of a head scratcher for me. But maybe it's just profit taking. Maybe it's just a normal 20-day test. Let's see. Keep an eye on the truckers and the railroads, because I think they're going to hold the key to the transportation index and also to the industrials. Normally, industrials go up when yields go up. Didn't really see that as much yesterday, especially with the transports. So let's keep an eye on that. All right. Let's move on to the 2021 review. And all I wanted to do here was just look at the sectors and industry groups on a relative basis. So this is energy relative to the S&P 500. Now, if we had the S&P 500 in here relative to itself, it would be at 0. That should make sense. The S&P 500 is going to do whatever the S&P 500 does. It's not going to outperform itself. It's not going to underperform itself. It's going to be at 0. So what this chart is telling us is which groups have led. And I pulled up the period of 1 year. So this includes yesterday. So it's not exactly 2021, but it's the last 52 weeks. So it's pretty darn close. And what we've seen is leadership from energy, real estate, financials, technology, consumer discretionary, in that order over the last year. Technology and consumer discretionary, I always like to see leadership, and we did have leadership. They weren't the best performers in 2021, and part of that was just the massive rotation that was taking place. Completely different than what we saw in 2020. 2020, energy was horrible. Energy really for the last decade has been horrible. We had a little bit of a dead cat bounce. And if you pull up the chart, this is the 10-year, actually maybe 15-year chart of the XLE relative to the S&P 500. And you can see it's been going down. In 2020, it collapsed. 2021, is this the start of a big move to the upside? Or is it just like a dead cat relative bounce? I'm going with the latter. I don't think energy is going to take off this year. Now, early in the year, inflation, crude oil prices going up. I mean, it's very possible energy does well to start the year. But I think later in the year, I think this downtrend is going to resume relative to the S&P 500. Now, it may not mean that energy prices altogether go lower. The XLE moves lower. It could simply be that the XLE later in the year goes flat or down slightly while the S&P rises. That would result in relative weakness. So just because the relative line goes down doesn't mean that energy stocks are going down. It just means that energy stocks are underperforming. Last year, they outperformed. So again, we can get back and take a look at that chart. Not only they outperformed, they had a huge outperformance, but it was a long time coming. I mean, if you're an energy fan, it's been a decade, maybe a dozen years or so since we've seen energy show that kind of leadership. To the downside, though, look at what was down the downside. We have utilities. In an up year, I expect defensive groups not to perform as well. Well, real estate had a great year, but consumer staples, not so much, and definitely utilities. These were two of the three that took a back seat. But also having down years were communication services, which is an aggressive area, and industrials, which is an aggressive area. So it was not the perfect kind of relative strength that we normally like to see with the market going up. And that's what, to me, made the stock market more difficult to trade in 2021. Of course, inflation was a problem that took out growth stocks a couple of different periods, including November and December. Many of the growth stocks got hit, and also back in February to May when the inflation rate was really starting to move higher. So there were reasons for it, but it was a whole lot easier looking back now and seeing that weakness than it was in that moment trying to figure where the strength was going to come from. I mean, inflation was a problem all year, but once May came around, growth stocks started taking back off again. yields started coming back down. The market Wall Street was saying, we don't really see a problem with inflation. So that's what made it difficult. You see all the headlines, inflation in this and inflation that, but then the stock market all of a sudden took off like there was no inflation problem whatsoever. Very, very interesting year, no doubt. I'm kind of glad we're into 2022, to be honest, from an investing perspective. I think things will start to get clearer as the year progresses. All right, let's move on to earnings spotlight. Not a whole lot going on right now. But in just a week or two, that is going to begin to change. We're going to see earnings season kick into full gear. Normally, the stock market does move higher into earnings. There's normally the pre-earnings advance. We'll see whether or not that's the case this year, but many times we do see movement to the upside. I actually would expect, with the yields moving higher, maybe some of the banks to start to see a little. We saw a rally yesterday. I wouldn't be surprised to see banks do well over the next couple of weeks as we move toward their earnings reports. They tend to be the first companies reporting earnings at the beginning of earnings season. So keep that in mind, maybe take a look at that. But here's a company that's reporting later today, Smart Global Holdings. This is a semiconductor, and this has been one of the really strong semiconductor stocks. Look at that AD line. Look at the recent breakout. I mean, semiconductors have been going sideways. They haven't broken out. SGH not only has broken out, but it's up 20% in the last 2 weeks. So I would be expecting a pretty big number coming out of this company later today. So watch for the earnings report on SGH later today. Other earnings coming out tomorrow, RPM International, Simply Good Foods, Thursday, Constellation Brands, Walgreens Boots Alliance, a couple of big ones there. But really, outside of that, not a whole lot of big earnings reports for another 10 days or so. All right, let's move on to the 3 you must see. Our first 3 you must see of 2022, at least here at StockCharts.com. I'm going to look at the 3 S&P 500 companies that had the biggest gains yesterday. Tesla hasn't broken out yet, but they came in with record sales or record deliveries in 2021. Huge response, big volume coming in. Watch 1250 area. That would be the all-time high. Tesla now over $1 trillion in market cap again. And I believe we're going to see a huge year ahead for Tesla, just my opinion. Next up is it was Tesla, Discovery, and then Occidental. So let's take a look at those. Discovery, this one had a big day, but it's been in a downtrend. So you see the difference here. Tesla, one of the leaders. Discovery, not so much. So yes, it was a good day, but there's a lot of work to be done here. The last one I have for you is Occidental Petroleum, OXY. This is in that energy space. And when you look at Occidental, big day yesterday, as we already know, but been going mostly sideways. I'd like to see a move back through the 50. I'd like to see the PPO get positive and then start seeing a trend above the 20-day. Now, we had been mostly trending below the 20-day, so that big volume move back through the 20 could reverse things. I'm still not overly impressed by this AD line, which is very weak, so I would just be careful here. All right, that's it from me today. I appreciate everybody tuning in. Again, Happy New Year. I wish everybody financial prosperity. I hope you have a safe year in 2022. Hope everyone remains very healthy, and let's all have a great year together. For now, that's it for Trading Places Live. I'll be back on Wednesday over at earningsbeats.com for your next Trading Places Live show. Have a great day, everybody. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.